Sophie, and good morning to everybody. Blake, welcome. Good to see you finally. Deborah, Al Arreola, and the South Chamber. Thank you very much for joining us. We really appreciate it, and I look forward to the discussion here. And I also want to thank all the participants that have come on board. Sophie, you work very hard on these presentations, so thank you also for putting this together. So today it's my pleasure to introduce Ms. Deborah Guerrero. And Ms. Deborah Guerrero has been very active in our community for many years, not only as an elected official, but she's a big part of our chamber and she's a big part of the community. And we really want to welcome her today. She was selected to the board, our board in 2012, unexpired term, which I think is a great term. And she was elected to a full term in 2013. She's a fifth generation SAISD resident. She earned a bachelor's degree in political science from St. Mary's University, a master's in public affairs from the Lyndon Baines Johnson School of Public Affairs, and a doctorate of jurisprudence from the University of Texas School of Law. She previously served 2 terms on the San Antonio City Council from 97 to 2001. And she is employed as a multifamily residential developer and continues to participate in neighborhood and community organizations throughout the city. Again, very involved in the community, a great public servant. And Ms. Guerrero, Deborah, thank you very much. Over to you.
Thank you, General, and good morning, everyone. And working with the NRP group, the multifamily developer, as a multifamily developer here in the city for the last 16 years and actually throughout Texas, the situation that we're in right now really does truly impact not only our ability to develop, to construct and build, but also as property managers, our residents. And so I'm very pleased to have Blake Hastings here today with the Federal Reserve Bank, and really with Federal Reserve. And really, I met Blake back when I was on City Council, gosh, back in the late 90s, early 2000s, Blake, when he was working with the Free Trade Alliance. He says some really cool things in Japanese. So I think it's Japanese, right, Blake? And that's last time we were on the plane, or Chinese, one of the two. I mean, he's multilingual is the bottom line. I think he can say a few things in Spanish too. But the fact is that Blake's involvement, not only in San Antonio and Texas, but worldwide, is the perspective that the federal bank gets when they get Blake Hastings as their senior VP. I'm really interested in hearing about consumer confidence, the Federal Reserve's role in that. We recently, I know the Chamber has polled and found that consumer confidence is a real issue for our small businesses. How do we bring that? How do we elevate that consumer confidence? Especially with 436 new cases yesterday, a huge spike in San Antonio. A lot of that we know has to do with more testing, obviously, which we're glad that people are getting tested, just don't want them to test positive. And then also the reopening of businesses in Texas. And so even though we can't deny that reopening has definitely increased retail sales, I mean, we're seeing it nationwide, but despite that, we still have high unemployment. And so the Federal Reserve is really instrumental in the outreach to the community, in the interest rates they set, and in really helping with that consumer confidence. And we want to know how we can help you all continue to elevate that so we can get back to some sense of recovery and normalcy. So without further ado, I am going to turn it over to the amazing Blake Hastings, Senior VP. He oversees all of San Antonio and Central and South Texas for the Federal Reserve. And Blake, I'll turn it over to you.
Thank you, Deborah. Thank you for that very, very kind introduction. And General Ayala and Al, thank you very much. And thank both the Hispanic Chamber and the Southside Chamber for hosting this event. And I want to thank everybody who's on the video today for taking time out of your busy schedules to hear from us. And what I'd like to do today is give you a short presentation about kind of where we see the economy today, particularly starting off at a national level and then moving on and talking about the state of Texas and then ultimately San Antonio a little bit. If you go ahead to the next slide, and the one after that, please. One more. Did we lose the presentation? There. Yeah, let's stay there, right there. So a couple of words that I'd like to say before I dive into the bulk of the presentation. One of the things that we're really focused on right now is understanding what's happening in particular on Main Street, on the economy at the grassroots level. A lot, you'll hear a lot of presentations from the Federal Reserve. You'll hear our Federal Reserve Chairman, Jerome Powell, talk about the national economy. You'll even hear some of our Fed presidents, like the one I work for, Rob Kaplan, who's president and CEO of the Dallas Fed, talk about the national economy. And sometimes it can come across as though we're focused on the big picture. We're kind of looking at things kind of at a theoretical or high level. But one of the things I want to assure you is that every day, myself and my team, many of whom are on the video today listening in, and our counterparts in Houston and El Paso at the branches there, as well as our home office in Dallas, and then our counterparts all over the country. In fact, if you'll go to the next chart, you'll see a map of the Federal Reserve System that I represent, and that is, I work for the 11th district based in Dallas, but you can see where the other reserve banks are based. And every day, myself and my colleagues here in San Antonio, as well as all across the country, we're doing what we can to understand what's happening in the real economy on Main Street. We put a lot of time and effort in understanding, in particular, what's happening with small businesses, because as everyone on this call knows, more than 80% of all jobs in our country are created by small business. At the Federal Reserve, we have a dual mandate of stable prices, meaning no inflation or deflation, as well as maximum sustainable employment. So it's impossible to think about that mandate, particularly the employment mandate, without thinking about small business. And you can't do that from a perch in Washington, D.C. You have to be on the ground. You have to have boots on the ground. And that's what our branch offices, like the one I'm proud to represent here in San Antonio, that's what we do every day. The other thing I want to emphasize is not only are we sensitive to the plight of the small business and doing our best to talk to small businesses, medium-sized businesses, and even larger ones every day to understand what's happening, we also understand the human impact of the coronavirus, of COVID-19, and what that's doing to people's health and the unfortunate lives that it has taken, and what that's doing to families. So I don't want to come across as though we're detached from these realities, because we live them too. We've had employees of our organization who have fallen ill and even passed away due to the virus. So we get it, we understand it, and we're here in your community and we live it every day. Another point that I want to make, I don't want to spend too much time on it, but our president, Rob Kaplan, made some comments that made some national headlines the other day that I think are important. And that is, in addition to the COVID-19 pandemic that's going on right now, we also have a lot of social things going on in our country right now that are very important. And we do believe at the Dallas Fed that systemic racism is a problem for the economy, in addition to all of the other social ills and injustices that it brings about. It also creates an inefficient and less effective economy as well. And so we're going to be speaking more and more about that as the Dallas Fed. We get it, we understand that. And I just want to share that message with you, because I think I was very proud of our president, Rob Kaplan, when he made those remarks, and I think they bear being repeated. So if you'll go on to the next chart. So this is a breakup of the 11th district, the organization I work for and my colleagues work for. You'll notice the different territories there. We work for the San Antonio branch, which covers the lightest blue region of Central and South Texas. Our counterparts in Houston, of course, cover Southeast Texas. And of course, our counterparts in El Paso cover West Texas and Southern New Mexico. So that just gives you an idea. But to give you a sense of who are the kind of people that we talk to every day, if you'll go to the next chart, you'll see our San Antonio branch board of directors, which represent businesses and civic organizations from across that territory that I just showed you. Jesus Garza, formerly with the Seton Healthcare System and former city manager of Austin. Paula Gold Williams, who I think everybody knows, who's our fantastic president and CEO of CPS Energy, Charlie Amato, who's a member of the Texas Business Hall of Fame, who runs Southwest Business Corporation, a multifaceted financial services firm, Al Jones with American Bank based in Corpus Christi, Robert Lozano with F&B Brands. Robert is an owner, a franchisee of Dairy Queen stores all throughout South Texas, more than 40, as well as some Schlotzsky franchises as well. So nothing is more Main Street than Dairy Queen. And so we really appreciate Robert being on our board. Denise Trouth, who gives us, of course, an education perspective and what's happening in the future labor force, of course, doing a fantastic job as president at Texas State University. And Tyson Tuttle, one of our newest additions to the board, president and CEO of Silicon Labs, who, of course, brings that tech perspective from Austin that's very important for us to understand. But just to give you this snapshot, the reason I put it up here is multiply this by 30, and you'll get a sense across the entire country with each of our home offices and branches, the type of people we're talking to on a regular basis. In addition to that, we have advisory councils. We have roundtables that we do on specific industries. We do them here in San Antonio on the hospitality industry, on the healthcare industry. And then, of course, we always do small business roundtables as well. You get a sense of the hundreds and thousands of business leaders across the country that the Federal Reserve talks to every day to understand what's happening in real time in the economy. So I think it's important that you understand this aspect of the Fed. It's little known, it's little understood, and little appreciated how close the partnership with the private sector truly is. And I really believe the Federal Reserve is truly a public-private partnership. Next slide, please. So again, as I said before, we're really doing everything we can right now to help businesses of all sizes and consumers get through this unusual and extraordinary crisis that we've been through. If you want to look back in history to try to find any sort of close example, economic history of something like this, frankly, there isn't one. There is no playbook for what we're going through right now. And there's really no precedent for anything like this. The closest thing, of course, would be the Great Depression, but that had a lot of different circumstances and frankly took a lot longer to unfold than the current crisis that we've seen. But I want to emphasize that we're really looking at the Fed's response as the monetary authority of the United States, and sometimes in coordination with the fiscal authority like the Treasury Department and Congress, what we're doing to try to respond to the crisis and help both businesses and consumers alike get through these difficult times. So next chart, please. Keep going. So looking at it from sort of a timetable perspective, I think most of you are aware of these timetables, but I like to put this out there because it really gives you a sense of the rapidness of which things unfolded here in our country. We first began hearing about COVID-19 in late December, early January in China. That, as China shut down, that kicked off what we like to call at the Fed a supply side shock to the economy, meaning that a lot of the factories that supply US factories and supply goods to US retailers were interrupted. And so we started to see some of the goods and components that the US economy relies on being sort of interrupted, supply chains being interrupted by the early sort of steps or early phases of COVID-19. But that supply side shock quickly turned into a demand side shock and then a financial shock within just a matter of days, if not weeks. And that began to unfurl in late February and kind of carried through the early couple of weeks of March. As we began to see cases reported in the United States, you began to see the financial markets immediately respond, particularly as consumers and businesses began to pull back on their demand because of the uncertainty that the virus brought about. And then, of course, once we went into lockdowns and shelter-in-place type orders and restrictions, we, of course, saw demand for products and services in particular, plummet. And so, again, what started off as a supply shock in the early days quickly turned into a demand shock for the entire country from both consumers and businesses. And that of course, sparked a financial shock that we saw in the stock market. And we began to see where the Fed is focused in credit markets as well. And you can see the Fed was on top of things. I think we did a pretty good job of responding quickly. We began lowering the Fed funds rate within just a few days of the initial disruptions in the credit and financial markets. And then we, of course, opened up our policy all the way to zero on March 15th and began unfurling a whole series of liquidity tools that I'll talk about later to keep the veins of finance, the arteries and veins of finance open and working properly, and make sure credit was flowing to businesses and consumers alike, which is ultimately the job of the central bank during a crisis. It's to provide credit and liquidity anywhere and everywhere it makes sense, and to sort of lean into the crisis, lean into the breach, and make sure that we're stepping in and keeping the financial system and credit markets working as best we can. We did not do that during the Great Depression. We sort of stayed out of it. We took a laissez-faire approach, and we've of course learned very hardly what that mistake meant. So we weren't going to do that again, and we've responded pretty quickly. So next chart. So to put some context around where we're at today, I think it's important to kind of think about where we were at prior to the crisis beginning. And what you can see here is a chart that indicates all of the expansion since 1950 that our economy has seen. And you'll note the steepness of the curve shows how strong the economic expansion was, coming off of the zero baseline. You know, how far did it grow? And then going across the bottom axis, the length of the expansion. And you'll know that this most recent expansion that we were having before the pandemic was the longest on record going back to 1950. In fact, I would argue one of the longest on record in history. But you'll notice that it wasn't necessarily the strongest economic expansion. In fact, you'll see the trend has been that the more recent expansions have all gotten sort of progressively weaker. And so there's a part of the reason for the 2009 recovery being a little weak is we had a financial crisis that set that off. And history has taught us, not only in the United States, but across the world, that it takes longer to recover from financial crises than it does typical business cycle downturns. But also we have some other factors sort of driving against us, some what we like to call secular or long-term headwinds. And one of those is demographics. We have an aging society, and because of that, the workforce is not growing as strongly in the United States as it was, let's say, back in the 1970s and 1980s. And so as a result of that, the economy grows more slowly. Two things grow the economy: workforce growth and the productivity of the workforce growth. And right now, just to give you a sort of a data point, to give you a sense of where we're at with workforce growth, right now in the current decade that we're in and in the next couple of decades, workforce growth from native-born Americans, native-born to parents who were native-born, is actually going to be flat to negative. In fact, we think it'll be a net negative over the next 15 years or so. So that means native-born population in the United States is actually going to have a negative contribution to workforce growth. Almost all, and in fact, today, you can say the majority, if not all, workforce growth is either coming from immigrants or children of immigrants in the United States. And so the workforce growth we are having is being helped by that. That's not a political statement. That's not trying to get into the politics of immigration. It's just giving you the facts that, you know, workforce growth in the United States is slowing, and that's causing these economic expansions to slow. We're not unique. We're seeing this in Europe. You're seeing this in places like Russia, in Japan. You're even seeing this in China, where a one-child policy for 70 years is starting to take a demographic hold there. So next chart. Looking at it through the lens of labor force, which of course is one of our two mandates, again, stable prices, meaning no inflation or deflation, and maximum employment. This chart right here, I think, gives you a great idea of where we were in 2009. You can see sort of the peak of the unemployment rate around 10%, that gradually came down during the economic recovery and expansion that we saw beginning really in 2009. And the gray line going across is the estimated natural rate of unemployment. And what that is in economics jargon is that rate which is sort of expected to be normal at full employment. You're always going to have churn in the economy. You're always going to have people being laid off and being rehired. And that rate's somewhere around 4.4%. We believe it. It's not something that's observable, but it's an estimate that we have. But you can see for the last number of years, we were well below that line. And in fact, we're at full employment at plus. And so we were doing a very good job, and we weren't seeing inflation spike up at the same time. So we were really doing a great job. And then, of course, you see the spike up. And this spike up, of course, is the pandemic. It's the shelter in place, and it's the jobs that were lost and the unemployment that occurred. It peaked around 16% officially. There were some trouble with the data that the Labor Department, Bureau of Labor Statistics admitted to or sort of acknowledged. It actually peaked really around 19%. The most recent reading is 13.3. Again, if you correct for some of these data issues that they're having, it's probably closer to 16.5%, but coming down nonetheless. So that's the good news. As we look at these data points, we believe that at least for this episode, for this phase of things, the worst is now behind us, and we're beginning to show recovery. In fact, if we go to the next couple of charts, you'll see that we're beginning to see that in a number of ways. Looking at initial unemployment claims, and you can see this going back all the way to the 1980s on the bottom chart there. You can see, kind of the normal pace of unemployment claims. You can see the run up during the Great Recession, which is the gray shaded bar in late 2007 through mid 2009. And then you can see the giant jump in unemployment claims towards the end of that. Taking a more narrow view of it, just looking at the beginning of the year, which is the upper chart there, you can see again that the rapid rise, but you can see the decline coming down. So the number of people filing unemployment every week is coming down, but I must emphasize it's still at a pretty high and elevated level by any historic measure. So while we do believe the worst is behind us and we think things are starting to improve, by no means are we in a healthy place yet. The labor market is still very stressed and strained. In fact, as we look at it over the course of the rest of this year, in our best case scenarios that the Dallas Fed, our economics team, we believe the unemployment rate will probably come back down around 8% by year's end, assuming that there's not a second wave or that we have to go through another phase of shelter in place or social distancing type practices that could, of course, cause a second round of economic stress. So we do expect that while things will improve going through the rest of the year, we're not going to get over this as quickly as we would all like. It's certainly not as quickly as it came upon us. Next chart, please. Again, looking at some of our indicators that we look at, we have a quarterly GDP, which is an overall measure of the economy. And then we use a weekly measure of economic activity that we just developed at the Dallas Fed for the pandemic. We needed to be able to see what was happening in real time more carefully instead of waiting for data for an entire quarter or even an entire month. And often that data is not only lagged, but that data is subject to a lot of revision. So we created some weekly indicators as well. And really looking at that weekly indicator, you'll see that even though we're still down about 10% in terms of overall GDP activity, it's come off the bottom, which was a little bit closer to 15%. So things seem to be improving, but still down. In terms of GDP activity, gross domestic product activity for the rest of this year, we think we'll see some growth in the third and fourth quarters of the year relative to the second quarter. But that growth will still be slower than it was last year. And we expect to end the year either down 4.5% to 6%, somewhere between 4.5% and 6% year over year in terms of total economic activity for 2020 versus 2019. That's pretty significant. We've not seen a drop off like that. In fact, if you go back and you look at what happened during the Great Recession, we sort of bottomed out around a negative 4% during that period. So we think this one's going to be a deeper impact, but it's recovering nonetheless. And so we do expect to see growth return in the third and fourth quarters. Next chart, please. So now let me pivot and go ahead to the next chart and talk a little bit about Texas. So we do expect that Texas could get hit worse. I am pleased to report to you that even though we are saying this and we are sort of predicting that this is a strong possibility, it is not yet borne out in the numbers. So we're hopeful that we're wrong about this. But when you look at the makeup of the Texas economy and you look at those industries that have been most impacted by COVID-19, you'll note that Texas has a larger concentration of these industries. Pretty similar on leisure and hospitality, but you'll notice a lot of the other sectors, travel, non-essential retail, all of these sectors, we have a little bit more exposure to than the rest of the country. So for those sectors that are being more hard hit by the COVID crisis, Texas has a little more exposure to those sectors. In addition to that, and go ahead to the next chart. In addition to that, and we're seeing these layoffs, of course, hit all sectors, but you'll notice those sectors on the far left that are being most hard impact. We also have seen the mining sector, which is the energy sector here in Texas, be pretty hard hit. As you all, whoever pays attention to oil will know, oil plummeted at the beginning of the coronavirus crisis, the COVID-19 crisis, and has been slowly recovering. But even today, despite some of the recovery in prices are still not at a level that is a break even for drilling here in Texas. And so we've seen drilling activity and employment in that sector decrease. And that has a pretty good impact on the Texas economy, a pretty negative impact, I guess I should say, more so than most states. We are exposed to the energy sector and sort of the sort of ripple effects of the energy sector. The other thing that I'll emphasize, our economists have done some really terrific work looking at the makeup of jobs in Texas. And one of the things that they have figured out as well, in addition to the sectors that I mentioned before, the percentage of jobs in Texas that lend themselves to working from home is actually lower than it is for the national average. And here in San Antonio, even lower yet than the Texas average. What does that mean? It means fewer people in Texas and even fewer yet in San Antonio have the kind of jobs that can work from home. And that means that we're more exposed to layoffs because of the COVID crisis. And so while, again, that has not yet borne out in a lot of the numbers, time will tell if that proves to be true. We are more vulnerable than the U.S. As a whole. And so far, we've been lucky. We haven't realized that vulnerability, but I think it's important to put it out there that this is something that bears watching as things continue to unfurl. Next chart, please. If you look at our leading index, this is something that Keith Phillips, our economist here in San Antonio, who many of you may have heard speak before, puts together. This is the tool he uses for forecasting job growth in Texas. With the exception of the Help Wanted Index, all of the other indicators in the Texas Leading Index are negative. And if you add them all up, it's a 13.3 negative rating. That's pretty significantly low. What does that mean? It points to contraction. That means the Texas economy is contracting, which is not a surprise because we've seen that at a national level as well. But since I've worked for the Dallas Fed in 13 years, I've never seen all of these indicators this negative since I've been watching it. So it is pretty stark. But looking forward, excuse me, looking forward, next chart, please. We look at our outlook surveys, and we look both at the manufacturing sector, which is depicted in red, as well as the service sector, which is depicted in blue. And Texas service and manufacturing businesses are beginning to report a more or I should say a less pessimistic view than they were a month or two ago. So things are improving. Any reading below zero of these indicators points to contraction ahead. So these indicators still are pointing to a negative, to a contraction in the service and manufacturing sectors of Texas. But again, you can see we've come off the worst, and the outlook is beginning to improve pretty dramatically. We're coming back on the outlook pretty quickly. And so Deborah mentioned this in her introduction. This is a good indication of sentiment for businesses, particularly businesses of all sizes. And while it's still a negative sentiment and pretty negative at that, it's definitely getting better. In fact, we're improving. If you look at the comparison to 2008, 2009, these indicators are back below the trough, the low point of 2008, 2009. So moving in the right direction and hopefully back above zero pretty soon. But this is a pretty good indicator of what you can expect in the next month or two in talking to businesses. Next chart. So kind of looking at the tailwinds and the headwinds that are affecting the Texas economy. Texas job growth is typically faster than the rest of the country. We typically grow 1% faster in terms of job growth. So the long-term Texas average is a little above 2%. The U.S. average is around 1% job growth. So that sort of is a long-term trend. A lot of reasons for that. A lot of companies relocate to Texas. Very good, healthy business climate. A lot of favorable tax treatments, things like that have led to a faster job growth in Texas than the rest of the country. And we have pretty flexible labor markets and a good business climate. So those are things that are helping us weather this storm, I think, a little better than some regions, and will certainly help us in the recovery and then ultimately the future expansion that comes from that. But we do have headwinds that should be noted. I mentioned the low oil prices. Anytime oil prices fall to very low levels like where they are now, Texas job growth tends to slow below the US average. So we tend to drop below the national average when we see oil prices like this. Again, as I mentioned before, the less remote work capability is a headwind that we see right now, leading to perhaps more unemployment than would otherwise be seen. And we have more vulnerable industries, as I said before. So put it all together, Texas is facing a lot of headwinds. And these should be put out there in the interest of transparency and continue to be monitored. We're obviously not only monitoring these industries, but we're talking to business leaders in all of these sectors on a regular basis to keep an eye on how things are improving. And I'll tell you anecdotally, to the business leaders I speak to here in San Antonio, there's much more optimism than there was a month ago or even 2 months ago. In fact, surprising optimism that I'm hearing from a lot of folks. So that's good news, because businesses that are confident tend to grow, tend to expand, tend to hire, and do all those things. Businesses that are not do the opposite. So just from an anecdotal perspective, I think things are improving from those that I talk to. Next slide. So sort of looking ahead at what we're doing at the Fed, and I'll talk a little bit about some of our policy actions and then get to your questions. So anytime you have a financial crisis, there's an urgent need for liquidity. The job of a central bank is to make sure that the financial system is functioning properly and that credit is flowing to businesses and consumers alike. And the Fed's there to make sure that credit is flowing by making sure the banking system has all the credit and access to liquidity that it needs. And so this is a vital role that the Fed plays in normal times, but certainly during a crisis. And so obviously at the beginning of this crisis, we began to see symptoms very similar to those we saw during the financial crisis of 2007, 8, and 9. And we reacted quickly. So next chart, I'll show you some of the things that we've done. So, to support the overall economy, we used our traditional monetary policy tool of the Fed funds rate. We have basically cut that all the way to zero during emergency meetings that were not previously scheduled in order to respond as quickly as we could. And this promotes and stimulates economic growth across all industries across the board. Lowering interest rates makes it cheaper for consumers and businesses to borrow. Then we've focused very specifically on businesses, which is unusual. So the programs that we've done here, we've never done before. In fact, we could not legally do them until Congress passed the CARES Act, which authorized us to do some of these programs. So to help small businesses, everybody's familiar with the PPP program that the Treasury Department and SBA were rolling out. We supported that program through the banking system by providing liquidity to the banks by essentially letting them take their PPP loans and put them on as collateral with us to borrow additional money so they could go out and make more PPP loans. So we supported and augmented the PPP program to help small businesses. Again, not something you're going to read in the headlines, but something the Fed's doing in the background to make sure small businesses have access to that liquidity. Just opened up our Main Street lending facility late last week. Banks are applying right now as we speak and should be taking loans from small and medium-sized companies here in the next few days. Again, another tool to provide liquidity to small and medium-sized companies through the banking system. But the Fed is actually going to be owning some of these loans ourselves, taking on the financial risk, if you will, of lending to small and medium-sized businesses directly. Again, something we could not legally do before the CARES Act. So a new era for us in lending directly to businesses. But prior to that, we could only lend to financial institutions. And then, of course, for large firms, we've done a variety of different things, including funding the commercial paper markets, making sure that the way large corporations borrow money through commercial paper are functioning properly. And we've taken on some of that debt as well and making sure those markets are working. And then just to give support to households and businesses and communities alike, We've done, again, some new programs, a term asset-backed securities loan facility. That's a mouthful. What it basically is every form of credit that you know of, credit cards, student loans, auto loans, business loans, mortgages, often get securitized and sold in the financial markets. And we're making sure that those securitization processes are functioning properly. We're actually buying some of those securities ourselves to make sure that banks can lend through credit cards, through mortgages, through auto loans, through student loans, through small business loans, et cetera. So something that we're doing that doesn't directly go to small businesses, but helps banks provide that facility. And then we're doing primary and secondary market corporate credit facilities. Again, we're buying and selling both primary, so first issue corporate debt, and then those that are sort of resold on the secondary markets, again, to make sure that corporations have access to liquidity. And then lastly, and most importantly, are sort of uniquely, we're also now beginning to provide lending directly to municipalities. Again, not something we could do before the CARES Act. And so communities, including some here in Texas, have begun borrowing directly from the Fed, cities and county governments, to provide them with that sort of short-term smoothing out of their receipt of funds, particularly with hotel motel tax receipts and sales tax receipts having been impacted. We're helping smooth that out by providing 3-year loans to municipalities to help them through this process, so they can continue to provide essential services to their community. So next chart. So just kind of the road ahead, we're going to continue to watch things in real time. We've created a social distancing index using some cell phone data, aggregated, not individual data, that helps us kind of get a sense of how much people are social distancing or not. The new weekly index that I spoke about before, doing some private forecasting aggregation, and of course our surveys to really look at the economy in real time. This is new for us. We don't typically look in real time. We typically look at a month view or a quarter view, but because of the volatility of the situation, we feel like we've had to create new tools to really stay on top of it on almost a daily basis. And, what are we looking for? And these are things we want to hear from you. I appreciate General Ayala letting us use the surveys that the Hispanic Chamber has been doing of you all as part of the information we gather on a regular basis. Very concerned about the health of small businesses and their ability to survive this crisis. And so we're constantly asking questions of small businesses and banks who lend to small businesses. What's your survivability? How long can you go in the current environment? And the good news is, like you would expect, small businesses are agile. And when we first asked those questions in February and March, most small businesses felt they could hold on for 30 days, maybe 60. Well, here we are in June, and small businesses are now saying, I can probably hold on for another 90 to 120 days. That's on top of the time that's already passed. So small businesses have adjusted. They figured out how to change their approach to business, going online, curbside, whatever they've ever had to do, changing the way their workforce is doing business. And so the survivability is there. We were very concerned about it at the beginning because, as I said before, 80% of all jobs come from small businesses. And so if small businesses fail during this time, there won't be jobs to come back to as the recovery unfolds. And that's been a real concern for us. And that's why we've done all the lending programs for small and medium-sized businesses that you saw in the previous chart. So we're very concerned about that. And of course, consumer confidence. At the end of the day, Deborah touched on this in her kind introduction. So goes the consumer, and how the consumer feels, so goes the economy. The US consumer is 70% of our economy. And so if the consumer is afraid to go shopping, going out to restaurants, afraid to go to sporting events, and things of that nature, that's going to have an economic impact. And so even though people have adjusted a lot of their shopping behaviors and all of that, any kind of a second wave or second round of the COVID crisis that hits the consumer's confidence and the consumer's willingness to go out and go to movie theaters and things like that is going to have a pretty profound effect on the economy. No one can forecast this. This is really going to be driven by the public health response and the public health situation. We've said, our president has said publicly that testing, wearing masks, and contact tracing are going to be essential, we believe, to buffeting and supporting consumer confidence, giving consumers the confidence to go out. feel like they can do these things and not get sick. There's not a monetary policy solution for this. This is really the place for public health officials, but we cannot responsibly talk about the economy without talking about that the public health piece of this is essential. If we don't get that right and we don't do the best job we can do in the public health space, then the economy will suffer because consumer confidence won't be where it needs to be. And that in turn will affect business confidence. So let me stop there and move to the next chart and see what questions you may have for me at this time.
Thank you, Blake, for all that information. We did have a few questions trickle in. One of them was, what impact will having the federal unemployment plus up the $600 per week be on the overall economic health of the country this summer, assuming we don't have another way of stay-at-home/work safe orders in the interim?
Yeah, so that was an important caveat there at the very end. Again, controlling for no second round or second wave. What effect will the removal of the $600 additional support have? It's kind of a dual-edged answer that I'm going to give you. On the one hand, we've actually seen a number of workers have actually made more money during this time because of the $600 extra benefit, more above and beyond the salaries they were making before. So ironically, we've actually seen wealth and income improve for many households during this time because of that $600 extra sort of kicker, if you will. However, it's kind of having a perverted impact on the return to work. So many employers, almost every employer that we talk to that has hourly workers is consistently telling us that they're having a difficult time getting workers to come back because they're making more money as long as they're getting this extra $600 stipend than they would make if they came back to work at an hourly rate. So this is something that we're monitoring. Obviously, this is a fiscal policy response that Congress put in place. And so I want to be careful not to comment too much on fiscal policy, but from an economic perspective, we think the removal of the $600 will impact incomes as people go back to their normal salary levels. It'll actually come down a little bit, but we think it will spur more people going back to work and create the incentive for people to go back to work. So we think Congress is going to have to be delicate here about continuing to maybe provide support for those who cannot go back to work or their jobs are not returning, but at the same time, not disincent workers from going back to work whose jobs are ready, for them to come back to. And so that's kind of where we are right now. I can't put numbers on this. It's really difficult to kind of forecast this, but we know the extra $600 has had a positive impact on families that have been receiving it. But we also know that it's created this sort of disincentive to return to work, which is having an impact on businesses and their ability to reopen.
Thank you for that. One of the things that you mentioned, Blake, was headwinds. Could you explain why international trade with Mexico is a headwind?
So I don't know that international trade with Mexico is a huge headwind. What's really the headwind is, number one, if you live along the border, cross-border traffic has been shut down. And so a lot of the cross-border retail and tourism and things like that has been affected by the policy response to the crisis. But in terms of trade, the government has kept the border open for trade. But the trade with Mexico that Texas is very dependent on as part of its economic vitality has been slowed because of the macro economy slowing. So, for example, a lot of maquiladoras operate in the auto industry. While the auto industry has slowed during this point in time, and because of that, that's meant the demand for components from the maquiladoras has slowed. And so, as that activity has slowed due to the larger economy slowing, we've seen that have an impact, particularly on trade-related businesses here in Texas. So it is a headwind, but not a headwind necessarily because of any policy response, but it's really kind of a headwind because of the economy more generally. So think of that as sort of a lagging indicator of overall economic activity. If the economy is slowing, you're going to see trade slow. It's just a natural order of things. Unfortunately, or fortunately, depending on your point of view, Texas is the largest exporting state in the United States. It surpassed California a number of years ago. And so if you see a slowdown in trade, guess which state is going to be most impacted? Texas. And so regardless of who we're trading with, Mexico, China, you're seeing all those numbers decrease right now. And that's not unique to the United States. You're seeing this happen globally as well.
One thing you mentioned a couple of times was that the assumptions are based on no second wave or second round of economic stress. Given that we're already seeing a resurgence in COVID cases here in Texas specifically, are there projections or plans made in case of the second wave?
Yeah, and they're not positive. I will tell you that prior to the latest unemployment numbers coming out, which surprised everybody, that they were much better than we expected. We actually expected the unemployment numbers to be around 20%, and we were surprised to see them come in at 13.3, really 16%. So we're very pleasantly surprised. However, we do believe that there is a second wave here in the summer or in the fall, and that forces, whether by policy or whether just by consumer behavior and preference, that forces sort of another shelter-in-place type of dynamic that you not only will probably see the unemployment rate go back up, but probably will end the year close to where it is right now, somewhere around 13%. Is sort of what our original forecast. Now, we may adjust that forecast downward a little bit given the surprising better unemployment numbers we saw most recently, but the last forecast I saw, a second wave would mean unemployment in the mid to lower teens in terms of unemployment rate. And in terms of economic activity, instead of being off 4.5% to 6% total GDP, we might be off by something closer to 7 or 8% if we saw a second wave. So pretty dramatic numbers if we see a second wave. And that's why the public health piece of this is so critical.
You mentioned some of the programs the Federal Reserve currently has for businesses. How is the Main Street lending program different from the existing SBA loan programs?
Yeah, so two things. Number one, the SBA lending program, the PPP or Paycheck Protection Program, was very specifically to help small businesses, and even more specifically, to help them keep their employees on payroll. And so, and it was a loan forgiveness program. So, you know, if small businesses were able to keep, I forget what the percentage was, 75 or 80% of their employees on their payroll, and they could prove that, they could have their loan forgiven. And so it was kind of a very narrow thing. At the Federal Reserve, what we've done in the Main Street lending program is, because the PPP program was targeting small businesses, sort of missed medium-sized companies. We wanted to create a program that helped medium-sized companies and small, right? Basically providing loans. It's not conditional. We don't require anybody to keep employees at a certain level or anything like that. So it's sort of free of those conditions, but it is a loan. It's not a grant, and it's not a loan that can turn into a grant like the Paycheck Protection Program. It's more of a traditional loan at a very sort of affordable interest rate. And those loans are going to be sort of exercised through the traditional banking system. So businesses have to work through their banks in order to get access to this program. But it is a way for us to provide direct lending to businesses during this crisis and make sure they've got the liquidity and the capital they need to continue to operate. So that's kind of how it differs from the PPP program. We think it's a little more flexible in terms of how it can be used and what it can be used for. But it does have that one wrinkle that you have to pay it back as opposed to the PPP program.
Thank you. We have time for one final question. While communities have braced for tremendous declines in sales tax, the statewide numbers during March and April, actual receipts appear to be somewhat stable. Does this indicate an underlying strength in the economy, or would this be more attributed to the one-time influx of funding from the federal government?
Yeah, so that's a really good question. I think that the true answer to that is we really don't know. Although, and Deborah mentioned this in her introduction, we were pleasantly surprised to see very strong retail sales numbers in the most recent reading, and that is an optimistic sign. It's very plausible that a lot of those sales tax receipts were supported by the federal government, particularly the unemployment benefits that you mentioned before, and the $600 additional benefit that was being paid out. Some of the support that was going directly to municipalities and state governments as well could be helping. But when we talk to businesses, it could also be that while sales tax receipts look at the macro picture, you know, a lot of those could be online. And so some retailers could be benefiting from that, while other retailers, particularly smaller retailers, are not. So even though consumers may still be spending money, they may not be spending them in the same places or for the same things as we saw before. So your sales tax receipts might look like things are fine, but under the surface, a lot of trade-offs are being made, and that's having an impact on businesses. And so that's what we were concerned with. And that's why we were very happy to see the retail sales numbers come in so well. But we're still hearing, particularly from small businesses, small retailers, particularly from hospitality-related businesses, so restaurants, hotels, they're still struggling right now. And so that part of the economy is far from recovered, even though some of these sales tax numbers point to a good change and retail numbers point to a good change. You got to look below the headline number and look at the makeup of where those retail sales are happening and where those sales tax receipts are coming from. And you'll see there's a lot of shifting of demand to online from brick and mortar retail. And that, you know, that of course can have implications long term, not only to those businesses, but to the jobs that they employ.
Blake, I want to say thank you to yourself for this presentation, all the wonderful information and data, to the Federal Reserve as well. I also want to introduce Al Arreola. He's the president and CEO of the South Chamber of Commerce, who partnered with us for this to provide closing remarks.
Thank you, Sophie. Thank you, Blake, first and foremost, for that incredible presentation. We know it's not easy to source a lot of that data, and you put it in such an objective context for us. I think it's a lot of what we're observing firsthand in the streets, but thank you for again, that great presentation. Deborah and NRP Group, thank you for your community leadership. We're always excited when we see an NRP sign on the South Side, so we know some good quality projects are coming up. And of course, to the team at the at the Hispanic Chamber, especially Sophie, thank you for all your hard work putting this together. I think I'm also supposed to say that this video will be shared. Please share it also. Share it with folks that you think might find this information valuable. But I will now pass it over to Sophie. And again, thank you everyone for joining us today.
Thank you, Al. Again, thank you everyone for joining us today. As Al mentioned, this recording, this presentation has been recorded. It will be added to our YouTube page and will be shared as well. So if you have any questions, please feel free to contact me. Please feel free to share with your friends, and we hope you're able to join us virtually for our next webinar. Thank you, everyone.
Thank you, Sophie.